Chevron Corporation NYSE CVX is strategically positioned as a structurally resilient integrated energy major, distinguishing itself through a steadfast commitment to disciplined capital allocation and aggressive shareholder distributions. The long-term investment thesis is anchored by the company's ability to generate significant free cash flow (FCF) through efficiency gains and strategic portfolio quality upgrades rather than relying solely on high commodity prices. This approach, articulated thoroughly at the November 2025 Investor Day, fundamentally de-risks the company's financial profile and provides a compelling framework for compounding shareholder value through the close of the decade. Chevron's strategy is designed to create lasting value through consistent growth, focusing heavily on operational efficiency to set the industry standard for resilience and returns. A core strategic pillar is the commitment to maintain a highly defensive combined capital expenditure and dividend break-even price below $50 per barrel of Brent crude through 2030, irrespective of project activity. This structural defense provides an unparalleled shield against expected commodity price volatility, particularly relevant given projections for a potential global crude oil oversupply in the 2026 timeframe. This resilience is coupled with a measured growth mandate, targeting annual oil and gas production growth between 2 and 3% through 2030. Value creation for the institutional investor is predominantly driven by superior cash return kinetics. Chevron has established an ambitious capital return program planning to repurchase shares in a target range of $10 billion to $20 billion annually through 2030, assuming average Brent prices hold between $60 and $80 per barrel. This aggressive buyback schedule is reinforced by a track record of peer-leading dividend growth, with an average annual increase of 5% over the past 25 years. The commitment to shareholder capital returns acts as the primary lever for per-share value accretion, providing a flexible mechanism for distributing excess FCF and mitigating the risk of management deploying cash into marginal projects during commodity upswings. The structural strengthening of the portfolio has been dramatically accelerated by the acquisition of Hess Corporation. This strategic move has been immediately accretive, driving global production to a record 4.1 million barrels of oil equivalent per day (BOE per day) in the third quarter of 2025, representing a substantial 21% increase compared to the prior year. Furthermore, the integration is projected to yield $1.5 billion in annualized synergies, which will supplement the ongoing efforts to achieve $3 billion to $4 billion in structural cost reductions across the enterprise by the end of 2026. This strategy effectively establishes a structurally higher FCF margin base early in the plan period, creating a buffer against mid-decade commodity price softness and ensuring the robustness of the capital return program. Strategic architecture, delivering sustained value through discipline, financial resilience, and break-even defense. The cornerstone of Chevron's strategic architecture is its financial resilience, aimed at guaranteeing returns regardless of macroeconomic fluctuation. The most significant quantitative demonstration of this approach is the commitment to a combined capital expenditure and dividend break-even price below $50 per barrel of Brent crude, a target which the company intends to maintain through the entirety of the 2030 planning horizon. This defensive structuring of the business is a key differentiator, translating directly into the low execution risk profile frequently cited by management. By locking in this financial floor, Chevron ensures the sustainability of its dividend and core capital program even in periods of significant cyclical weakness. This disciplined approach extends beyond mere survival metrics to maximizing shareholder value through enhanced operational performance. Chevron has set a quantifiable target to improve its return on capital employed (ROC) by over 3% by 2030, based on an average $70 Brent price scenario. This mandate indicates a fundamental dedication to continuous portfolio quality improvement and operational excellence. Achieving this ROCE improvement is predicated not on market appreciation of assets, but on operational efficiency gains and strategic portfolio streamlining, which likely implies a willingness to divest higher-cost or non-core assets to concentrate capital in superior basins such as Guyana and the Permian. Supporting these financial targets is a rigorous approach to capital expenditure, CapEx. The company operates within a consistent annual capex guidance range of $14 billion to $16 billion through 2027. This consistency in spending, confirmed by the $14.5 billion to $15.5 billion capex guidance for 2025, is crucial. It signals that major portfolio growth objectives, including the integration of Hess and the scaling of the Permian Basin, are being executed within a stable, non-inflationary spending envelope. This predictable spending profile underpins the company's projection of durable free cash flow growth. Operational discipline and synergy realization. Chevron's ability to generate cash flow growth is directly tied to its success in realizing structural cost reductions and acquisition synergies. The company has explicitly targeted achieving a total of $3 billion to $4 billion in structural cost reductions by the end of 2026. This reduction effort is expected to be significantly bolstered by the $1.5 billion in annualized synergies specific to the integration of Hess Corporation. These combined synergy and efficiency gains are the underlying engine expected to drive greater than 10% annual adjusted FCF growth over the next 5 years, assuming a nominal $70 Brent price environment. By concentrating these structural cost reductions and acquisition synergies in the near term, specifically by the end of 2026, Chevron is taking strategic action to establish a structurally higher FCF margin base earlier in the plan period. This front-loaded efficiency provides a crucial economic buffer against the widely anticipated commodity price softness for 2026. Since FCF is inherently sensitive to operating costs, locking in cost efficiencies early ensures that a higher percentage of future sales revenue, even in a lower price environment, flows directly to the bottom line, thus de-risking the aggressive dividend and share buyback mandate from mid-decade price fluctuations. Operational evidence of this enhanced efficiency is already apparent. In the first quarter of 2025, Chevron successfully increased production while simultaneously reducing rig activity by 24% year-over-year, validating the success of its innovation and capital discipline strategy. 3. Core growth drivers and portfolio transformation. The transformative impact of the Hess acquisition. The acquisition of Hess Corporation represents a pivotal transformation for Chevron's portfolio, instantly delivering enhanced scale and resource quality. The transaction has proven immediately accretive, contributing significantly to the third quarter 2025 record output of 4.1 million BOE per day. Of this substantial increase, the newly integrated Hess assets contributed approximately 495,000 BOE per day. Critically, the acquisition secured Chevron a key strategic position in the prolific Stabroek Block offshore Guyana. This basin, which is managed by an ExxonMobil-led joint development group, represents a top-tier, low-carbon-intensive resource that is fundamental to ensuring Chevron's long-term organic reserve replacement ratio exceeds 150% through 2030. The deep project pipeline in Guyana is essential for stability. The fourth development, Yellowtail, started up earlier in 2025, and major subsequent projects, including the $6.8 billion Hammerhead project, have been approved and are scheduled to come online through 2029. The investment in the Stabroek Block strategically balances Chevron's portfolio risk, counteracting the heavy reliance on shorter-cycle U.S. shale and politically sensitive mature assets by introducing high-margin, deep-water assets that provide multi-decade cash flow stability, directly supporting the superior ROCE goal and the aggressive capital return program. Furthermore, the integration is expected to yield over $3 billion in increased annual FCF. Efficiency-led growth in the Permian Basin. Chevron's approach to the Permian has evolved into a disciplined strategy prioritizing capital efficiency and superior returns over unbridled volume growth. The basin remains a high-margin, low-cost driver for near-term supply growth and continues to receive significant capital allocation, with approximately $5 billion of the company's 2024 capex budget directed toward Permian development within the U.S. shale and tight portfolio.
The company utilizes sophisticated operational techniques to maximize output while constraining spending. These techniques include cube development, which involves clustering wells in geologically contiguous zones, and the application of advanced pad drilling, where Chevron utilizes 12 to 16 wells per pad, significantly above the industry average of 8 to 10. These standardization and integration efforts have reduced drilling time and costs and have led to demonstrable gains, including an approximately 53% increase in estimated ultimate recoveries, EURs, per well over the last decade. This technological and operational focus has allowed Chevron to increase production while deploying 40% fewer rigs than planned just a few years ago. This intense focus on industrializing operations to de-risk production targets and neutralize service cost inflation creates a durable competitive advantage in shale execution, ensuring that the core domestic growth engine can consistently meet the targeted 2 to 3% annual production growth without exceeding the strict $14 billion to $16 billion annual capex ceiling. Key international assets and diversification. Chevron maintains a vast and strategically diverse global upstream portfolio that provides necessary counterbalance to its domestic operations. Key assets include oil production in Kazakhstan, liquefied natural gas (LNG) operations in Australia, deepwater assets in the U.S. Gulf of Mexico, and natural gas resources in the Eastern Mediterranean. Major international projects continue to receive substantial affiliate capital expenditure, CapEx. Specifically, nearly half of the affiliate CapEx budget is allocated to the Tengiz-Chevroil Future Growth Project, FGP, and Wellhead Pressure Management Project, WPMP, in Kazakhstan. Furthermore, domestic deepwater projects, such as the Gulf of Mexico's Anchor project, are scheduled to achieve first oil in 2024. The company also navigates politically complex jurisdictions to maintain access to critical resource bases. Chevron has a long-standing presence in Venezuela, operating 5 onshore and offshore production projects in partnership with affiliates of Petróleos de Venezuela. While the company received new licenses earlier in the year, allowing for increased Venezuelan exports to the United States, the long-term operational stability and capital commitment in this region are heavily contingent upon evolving U.S. sanctions policy and geopolitical stability. This continued commitment to capital-intensive joint ventures and politically sensitive regions underscores a strategy of prioritizing deep-seated resource access despite inherent execution risks. The ability to navigate these complex diplomatic and economic landscapes is a necessary qualitative strength for a global integrated major. 4. Financial performance review and outlook. Revenue and earnings trajectory. Chevron's financial performance over the past few years clearly illustrates the extreme volatility inherent in the global oil and gas sector. The company's annual revenue experienced a dramatic 51.57% increase in 2022, reaching $246.25 billion, driven by the post-pandemic surge in commodity prices. This peak was followed by a sharp normalization, resulting in an 18.4% decline in 2023, with revenue settling at $200,949 billion. The trend of contraction continued into 2025, with the trailing 12 months ending September 30, 2025, recording a revenue of $194,384 billion, representing a 1.7% decline year over year. The decline in overall earnings metrics has tracked this revenue volatility. Net income per diluted share fell from a peak of $18.28 in 2022 to $11.36 in 2023, and further to $9.72 in 2024. Recent quarterly results reflect both the benefits of portfolio expansion and the ongoing impact of lower realized prices and strategic financial adjustments. Third quarter 2025 earnings were reported at $3.5 billion, resulting in adjusted earnings of $3.6 billion. This compares unfavorably to the adjusted earnings of $4.5 billion reported in the third quarter of 2024. Crucially, the Q3 2025 results included a net loss of $235 million attributable to severance and other transaction costs related to the Hess acquisition. Prior periods also saw strategic cleanup, such as the $1.8 billion U.S. upstream impairment and $1.9 billion in decommissioning obligations recognized in the fourth quarter of 2023. The recent divergence between achieving record production volumes of 4.1 million BOE per day in Q3 25, a 21% jump year over year, and the simultaneous reduction in net income confirms that the macroeconomic environment, specifically lower realized prices in 2025, remains the dominant short-term determinant of financial results. However, management is clearly prioritizing long-term portfolio quality, absorbing non-recurring charges like impairments and acquisition costs to ensure a leaner, higher return asset base that can achieve the stated ROCE improvement mandate post-2026. Superior capital allocation and cash return. Chevron's commitment to shareholder returns stands out among its peers. The company has explicitly stated its intention to repurchase shares within the $10 to $20 billion range annually through 2030, provided Brent prices remain between $60 and $80 per barrel. This aggressive, large-range targeted buyback program serves a dual purpose. It compounds earnings per share, EPS, by reducing the share count and acts as a necessary pressure release valve for excess FCF, reducing the temptation for management to fund marginal projects during periods of high prices. The effectiveness of this capital return mandate is already visible in the company's capital structure. The weighted average number of shares outstanding has seen a significant reduction, falling from 1,901 million at the end of 2022 to 1,754.8 million by the end of 2024. The company consistently demonstrates its capital allocation priority, returning a record $7.7 billion in the third quarter of 2024 alone through a combination of dividends and share repurchases. Furthermore, Chevron maintains a superior dividend profile, leading its peers with an average annual increase of 7% over the past quarter-century. The current dividend yield of 4.1% is notably above the company's 10-year average. 5. Energy transition, ESG, and new growth vectors. The lower carbon strategy and differentiated approach. Chevron's approach to the energy transition is distinct among global majors, focusing primarily on leveraging its existing capabilities to advance a lower carbon future without fundamentally shifting away from its core hydrocarbon business. The strategy centers on three main action areas: cost-efficiently lowering carbon intensity, increasing renewables and offsets to support its own operations, and investing in low-carbon technologies to enable commercial solutions. This strategy is anchored by the company's belief that continued oil and gas production by the most efficient operators is not inconsistent with overall goals for reducing fossil fuel emissions. This contrasts sharply with the approach of certain European majors, such as Shell, who prioritize reducing absolute emissions. Chevron instead emphasizes carbon intensity reduction and efficient methane management. By centering its strategy on intensity reduction, Chevron effectively links its sustainability goals directly to its core operational efficiency objectives. Operational improvements, such as methane abatement and flaring reduction, serve the dual purpose of reducing operating costs while simultaneously lowering carbon intensity, thereby supporting the superior ROCE goal without necessitating the deployment of substantial capital into external, high-risk green energy ventures outside of core expertise. The company is highly sensitive to policy risks and incorporates preparedness for regulatory change into its long-term planning. It utilizes carbon prices and derived carbon costs in its business planning, investment decisions, and reserves calculations. This preemptive measure is essential because, as of 2020, over 60% of Chevron's total Scope 1 and Scope 2 equity greenhouse gas emissions originated in regions with existing or developing carbon pricing policies. Low carbon capital commitment and new ventures. Chevron has quantified its capital commitment to the lower carbon strategy, signaling financial backing for its initiatives. The company is targeting $2 billion for carbon reduction projects by 2028, coupled with an additional $750 million dedicated to investments in renewables and offsets by the same year. These investments are focused on integrated solutions that leverage existing assets and infrastructure. For instance, the downstream and chemicals segment is a critical part of this strategy, with two major chemicals projects anticipated to start up in 2027. Furthermore, the company's Geismar renewable diesel expansion project is forecasted to begin startup in 2024. A notable new growth vector leverages Chevron's resource base to tap into adjacent high-growth industrial markets. The company plans to deliver its first AI data center power project in West Texas, targeting first power delivery in 2027. This initiative represents a key synergy play, allowing Chevron to monetize natural gas or reduced emissions power from its Permian assets by selling directly into the high-margin, rapidly expanding digital economy.
This effort strategically moves the company beyond simple commodity extraction into the more stable, utility-like generation space for industrial consumers, providing a diversified revenue stream that aligns with the overall goal of maximizing resilient, predictable cash flow growth. V. Investment risks, competitive positioning, and valuation. Macro commodity outlook and oversupply risks.
The principal short-term macroeconomic risk facing Chevron is the projected weakness in global oil prices for 2026. The prevailing consensus forecast indicates persistent downward pressure as swelling global supplies are expected to outstrip modest demand growth, leading to a projected surplus of 0.5 million to 4.2 million barrels per day. Energy prices generally are projected to dip approximately 10% in 2026. Specifically, Brent crude forecasts for 2026 average between $55 per barrel, according to the EIA, and $62.23 per barrel, based on a Reuters poll, with JP Morgan Research projecting $58 per barrel. While Chevron's structural defense, characterized by its sub-$50 break-even, offers robust protection against price collapse, a sustained Brent price hovering below $60 per barrel in 2026 would introduce significant financial tension. This lower price scenario would severely challenge the maximum capacity of the company's aggressive $10 to $20 billion share buyback program, which is explicitly predicated on Brent prices residing within the $60 to $80 range. If realized prices drift toward the conservative consensus forecast of $55 to $58, the free cash flow available for the buyback program would contract, potentially dampening the high projected EPS accretion that relies heavily on the upper range of the buyback mandate. However, geopolitical risks, including ongoing political instability, are expected to maintain a crucial risk premium, preventing prices from falling as low as supply-side dynamics might otherwise dictate. Geopolitical and reputational risks. As a global integrated major, Chevron maintains exposure to several high-risk geopolitical theaters. The continued participation in 5 production projects in Venezuela, in partnership with PDVSA, exposes the company to extreme political instability and immediate risks associated with evolving U.S. sanctions policy. Any short-term shift in regulatory approach could disrupt oil exports and operational stability. Furthermore, operations in regions like the Eastern Mediterranean, where Chevron is involved in Israeli gas fields, introduce exposure to complex regional maritime and land boundary disputes. The necessary complexity of Chevron's global resource strategy, which requires capital commitment to politically volatile regions, inherently accepts a higher level of geopolitical and social risk. This factor necessitates applying a higher discount rate to these ventures, making the cash flow stability from lower-risk assets like Guyana and the Permian essential for maintaining the overall portfolio resilience. Additionally, the company is acutely exposed to reputational risks globally, having faced historical challenges related to land rights and community relations in multiple operating jurisdictions, including Kazakhstan, Angola, and Argentina. Peer benchmarking, analyst consensus, and valuation summary. Chevron's competitive positioning focuses on capital discipline and efficiency. In the highly competitive integrated oil and gas sector, Chevron is benchmarked against peers such as ExxonMobil, Shell, and TotalEnergies. ExxonMobil, for instance, reported earning returns higher than its peers in 2024, achieving $33 billion in earnings during a year where capital expenditures reached $27 billion. Chevron differentiates itself from companies like Shell through its intense focus on operational efficiency and a carbon intensity reduction strategy that seeks to maximize returns while maintaining a focus on high-margin hydrocarbons. Valuation metrics currently place Chevron's shares trading at approximately 20 times forward earnings, which is generally consistent with the average for its integrated peer group. The analyst consensus price targets are notably clustered, with an average target of $170 to $172 per share, suggesting a potential upside of 12 to 16% from the recent trading levels near $152 per share. For example, one valuation exercise yields a fair value estimate of $172.80, classifying the stock as undervalued. However, more conservative valuation models, which place greater weight on the forecast of a moderate 1% annual revenue decline through 2027 and employ a lower price-to-earnings multiple, suggest a 2027 valuation closer to $142 per share. This significant divergence in valuation targets fundamentally reflects differing views on two critical factors: the sustainability of future free cash flow in a volatile commodity environment and the execution risk associated with the aggressive share buyback program. Since revenue is expected to contract in the near term, any earnings per share growth must be successfully driven either by margin expansion realized through the targeted $3 to $4 billion in structural cost reductions, or by the denominator reduction achieved through the successful execution of the share repurchase mandate. Therefore, the investment thesis hinged on the higher valuation targets is contingent upon the delivery of flawless execution on all capital discipline mandates and synergy realization targets. V. Conclusion and outlook. Chevron Corporation presents a well-defined investment case characterized by robust financial discipline, a high-quality portfolio significantly enhanced by the Hess acquisition, and an industry-leading commitment to returning capital to shareholders. The company's strategic objective to grow free cash flow by over 10% annually while simultaneously guaranteeing a sub-50 per barrel Brent break-even through 2030 establishes a low-risk foundation for predictable performance. The successful integration of Hess, resulting in a 21% boost to production and immediate access to the high-margin Stop-Roke block, effectively mitigates long-term resource depletion risk and balances the portfolio against the efficiency-led yet potentially faster-depleting Permian growth engine. The projected $4 billion to $5.5 billion in combined cost and acquisition synergies is critical, providing the necessary FCX expansion to fund the ambitious $10 to $20 billion annual share buyback program. While the immediate financial outlook is sensitive to macro pricing, with 2026 Brent forecasts potentially challenging the high end of the buyback mandate, Chevron's operational improvements and structural de-risking position the company favorably to outperform peers in a volatile or softening commodity market. The company's focus on intensity-based carbon reduction, coupled with strategic ventures into new sectors like AI data center power, ensures that capital allocation remains focused on high-return, core competencies while adhering to evolving environmental mandates. For the investor prioritizing long-term capital preservation, consistent income growth, and high free cash flow visibility, Chevron remains a premier choice. The primary determinant of near-term stock performance will be the tangible quarterly evidence of synergy realization and the scale of the share repurchase execution. Should Chevron consistently demonstrate its ability to deploy the maximum intended capital to buybacks, the valuation consensus will likely converge toward the higher analyst target range of $170 to $172 per share.